Hello everyone, welcome back to Sudden Wealth. If you do enjoy my content, please kindly leave a like and subscribe and leave a comment, even if it's a negative one. Every comment is welcome. Today I'd like to talk to you a bit about the banking crisis, which seems to have been subdued. And this is actually my specialty, so I would like to basically cover a few things with you guys. Number one, of course, we've seen three small, but if you look historically speaking, they are quite large in American history of bank failures. And then you had one of the Swiss banks going bankrupt, which is actually quite, if you follow anything about banking, it's a bit of a miracle how they lasted so long. I mean, we got to a point with the Swiss bank in which every scandal, every wrongdoing, every bad thing, every fine, every breach of policies, whatever you can think about, their name would pop up, Credit Suisse, every single time. And then bad decision making, then it becomes a burning ship. Nobody wants to join. Management deteriorates. The staff, as you can imagine, is not very, motivated. So you have a complete shit show. There were rumors and issues around Deutsche Bank in the past in Germany. Yes, also a terrible bank, one of the worst in Europe in terms of performance. It's just, just look at their financials. Don't take my word for it. But I do believe that bank is more important overall in the great scheme of things, and I don't think it's going to be let to fail. But what about these American banks? Look, this is something about banking that people need to understand very well. When you place deposits at a bank, the bank does not lend your money. Your money is always there. Now, what happens is the bank goes to a central bank and says, hey guys, I have €1 million, $1 million, £1 million, whatever, in deposits. Give me 10 million. And the Fed or the ECB or the Bank of England just create that money out of nowhere. And now you are leveraged 10 to 1. Now, some banks are more prudent, so they hold extra reserves. Other banks use that extra cash to lend it out and to provide, either typical bank loans, trade finance services, whatever. And the other portion, which is held in reserves, has been, so banks, as they're chasing yield, they will buy long-term debt with the idea of holding it to maturity. So for example, if they buy 10-year government bonds, they are planning to hold them until 2033, and they collect the interest every year. Now, if enough people withdraw their cash from a bank, any bank, JP Morgan, the best banks in the world, doesn't really matter, you collapse the bank. So what ends up happening is, in the past 10 years, we've been in this environment of extremely low interest rates. So when the bank accumulated a lot of this long-term government debt. But when the Fed starts to raise rates, your low interest debt becomes much less attractive. Why? Because you can just go to the market and buy a new one for double or triple or 4 times the interest. So why would you buy the old debt? You only buy it if you have a very steep discount on the value. So if that bond is worth 100 million at 1%, but interest rates are now 4%, maybe out of that 100 million, if you sell it for 20 million, maybe somebody will buy it. But that's about it. Now, why is this typically not a problem? Because banks have a special accounting regime in which they hold these assets called hold to maturity. So you don't need to report fair value. That means this decrease of the value of the bond that I just said. You can just hold at the price you paid. So 100 million euros, $100 million, 100 million pounds until maturity. But money market products, which are basically short-term fixed income instruments, have become very appealing. Why? Because they're paying 4%, 5% on an annual basis, which is substantially higher than deposits. So people start to take money out of the deposits to place in these instruments. What is the problem with this? Because no bank in the world has enough money to give you back if sufficient value of deposits is withdrawn. So what happens? These banks are then forced to take these bonds that are supposed to be held to maturity and sell them before their time, which means that the paper loss from the interest rates rising becomes a real loss. So that's why nobody paid attention, and how banks can report billions of losses, and people, just out of nowhere become very surprised. And then, of course, if you manage to find the next bank failing, you make a lot of money shorting. So it then becomes a game of find the next weak link. But then if you start shorting a lot a stock and that stock gets sold, then people start to think, oh my God, there's something wrong with that bank, which means they take their deposits out of there, which means they need to sell bonds, which means they need to record losses, which means more people sell, which means etc., etc. So it becomes kind of a loop. So why was, for example, Silicon Valley an experienced bank? Because the only thing they had to do before announcing any kind of capital raises, we just call the Fed and say, please open the discount window. The discount window is like an emergency liquidity tool in which banks can, if they are having liquidity shortages for a brief period of time, they can go there and just get cash directly from the Fed. Now, the gold bags will tell you, oh my God, but that's going to cause inflation. Actually not, because you are suppressing a temporary need on the system, in which, let's say, the newly given cash to a bank is just replacing what the bank then needs to give back once the situation stabilizes. So it's a bit like this. If you talk to a gold bug, he will tell you if the Fed prints money, that's inflation. Yeah, well, it depends, right? Because if the Fed prints $1 trillion and buries it under the sea, is there real inflation? In the sense of, will prices rise? No, because they did create money out of nowhere, but the money never touched the real economy. So that's why we managed to print money for 14 years, and they have fairly low levels of CPI. But as soon as we start giving money directly to people and shutting down supplies, then of course you then start seeing inflation. And by the way, if you had one of the biggest wars of the last 50 years, then of course you're going to have inflation. But in any case, what's the summary of this situation? With this discount window from the Fed and other emergency liquidity measures for banks, don't expect many more banks failing. But if you do see banks failing, they're going to be regional small banks. Why? Because the system of regional banks does no longer make sense in a digitized world. Like, this used to be very important in the old days, where the local knowledge of, let's say, the market in Kentucky is completely different than the same local knowledge of the market in, let's say, I don't know, Hawaii or New York. So it would make sense to have regional banks for those intricacies. But nowadays, does it really make sense? I don't think so. I mean, in Canada, you have pretty much 4 banks. In France, you have 4 banks. In Spain, you have 3 banks. In England, you have about 4 banks. So maybe you don't need a million. In Japan, you have 3 banks, 3 main banks. And then you have, of course, some investment, kind of investment banking, with Nomura. But in any case, it seems clear that this model of the 5,000 small banks no longer works. So I do believe if you see banks going bankrupt, it will be the smaller ones. I do think that for the larger ones, the Fed will just open the discount window to just get emergency liquidity. And that's about it. And now what the banks need to do is sufficient time to accumulate debt yielding 3%, 4%, and 5% to replace their maturing debt at 1.5, 1.25% that they've accumulated in the previous 14 years. It's a pretty much what you need is to bridge the time between the maturing of those very low interest bonds in the past until they get matured. So the bank gets the money back, and then they can buy the new 3%, 3.5% bond, and then the reserves should be back to be okay again. But look, in summary, the banking business has never been very appealing because you're always subject to, if sufficient people withdraw cash at the same time, you have a huge liquidity issue. So it's just the nature of banking. Apparently people along the lines forgot. So in any case, I hope that this video was useful, and see you in the next one.